and this is absurd, it's a bubble. That's their explanation. No, that's not the right explanation because they've got the wrong description. The description is these are network businesses, and network businesses, the bigger they get, the more profitable they become, the higher returns that they can get. And then when you overlay them in the global marketplace, we're not talking about 360 million people here or 380 million people here in the United States. We're talking about 8 billion people on the planet.
Today, I want to discuss some important topics I think the audience will enjoy learning from regarding your investing frameworks and interesting takeaways you've had, not only from Warren Buffett, but from many different people in many different fields of expertise. To kick it off, let's discuss a topic that many investors don't think of very often, and that is the use of reading fiction for improving one's investing. In one of your earlier books, The Detective and the Investor, you do a wonderful job of using the lessons from famous detectives to improve the investing process. Charlie Munger famously says he doesn't read any fiction, but after reading this book of yours, I can see the value in reading great works of fiction. So what are your thoughts on reading fiction to improve your investing framework?
Well, I think reading fiction is definitely a big help. Because you get to immerse yourself in the experiences of other people that are going through a life, fictitious, whatever, but they're going through life, solving problems, dealing with issues, and it kind of broadens your awareness of kind of how to think about the world in so many ways. The decision to write the detective book really was a testament to my dad. My dad was a big Rex Stout reader. He wrote the mystery books, the Nero Wolfe books, and I grew up reading them and always thought they were fascinating. And what at the core of reading, detective stories, Kyle, is a sense of puzzle solving. And let me just back up one more sense. If a mystery has been done correctly, they should be able to give you enough clues throughout the book. Some hidden, but they're there if you can, if you concentrate on them, that can help you solve the puzzle. That's fair play in detective fiction. And then furthermore, we drill down into what were called, the great detectives, the mental detectives, who basically solve mysteries by their mental acumen, as opposed to maybe Sam Spade, who would pistol whip a confession out of you to get the answer. That's not fair play. We can't do that in investing. But the three great detectives were Auguste Dupin, who was obviously the very first detective, written by Edgar Allan Poe, and then obviously Sherlock Holmes, would be the second one. And the third one was somewhat of a surprise to me. It was a Father Brown, a cleric detective, that was the brainchild of a British writer named Gilbert Keith Chesterton. I think personally, I would add, maybe Hercule Poirot from Agatha Christie, but he didn't make the top three. But anyway, we focused on those three and went through all of the short stories. And I came away with the sense that, there's something here that if you thought like a detective in trying to solve a mystery, it probably would help you in thinking about analyzing stocks or thinking about markets.
Yeah, and I definitely want to talk more about some of the takeaways here. But in terms of investing specifically, do you have any other genres of fiction that you would suggest to the audience member society?
Great question. I'm looking at my library. I've gone through Cormac McCarthy's books. I think he was brilliant. He passed away this year at age 82. I liked all of his Border trilogies. I thought they were really quite good. I've gone through Moby Dick. You always want to read the classics. So you kind of go through Moby Dick. I did a little bit of Faulkner, a little bit of Hemingway. But most of the time I've been spending, in philosophy and some of the sciences. So not overdosing on fiction, but turning to it every once in a while just to keep your brain fresh.
Love it. So going back to the detective and investor, my three biggest takeaways were: 1, always be skeptical and don't accept conventional wisdom. Number 2, remain open to contrary information and don't be afraid to change your hypothesis when the information available tells you to do so. And then 3, develop a firm understanding of human psychology and develop the ability to put yourself in the market's shoes. So after writing the book, which principles, is it one of these ones that you learned from Dupin, Holmes, and Father Brown, do you think had the biggest impact on how you analyze businesses?
Well, all of them are important, and you touched on the most important ones with DuPont. Auguste Dupin, it really was the thoroughness of the investigation. And when Edgar Allan Poe wrote that, you really were just kind of overwhelmed at how he looked at the tiniest details and putting it together. Obviously, Sherlock Holmes, also tiniest details, and also were, I think, unemotional. They didn't really have any preconceived ideas of who was guilty, who was not, what had happened. They just let the facts lead for themselves. And what was great about Holmes, and it kind of reminds you of also John Maynard Keynes, when the facts change, you change, right? And that's hard. That's hard for investors because they kind of come away with a viewpoint about a stock, and if they like it, they like it. And even if there's contrary evidence that says you may not like it as much as you think you do, the tendency is to resist forming a new description of that company. So a lot of people struggle with that. But if you said if I had to take away one, it would be Father Brown. And it's because what was great about those short stories, Kyle, was how he could twist them in such a way to give you a description of what happened. So he would lay out the mystery, and he would go through the mystery and reading what happened, and he had it pretty well. And then the constable would come, or somebody would say, this is what happened. And then Father Brown would look at the same thing and he would describe it differently. And this relates to philosophy, particularly to Wittgenstein, Ludwig Wittgenstein, an Austrian philosopher who, considered to be one of the great 20th century philosophers. He was a philosopher of language. And by language, it was, the words that you choose give things meaning. Meaning gives you an explanation, and that explanation ultimately forms the description, right? And so we all have these descriptions based upon explanations, based upon the words we choose to explain what's going on. But if you have failed to describe what is going on accurately, and we do that in the markets all the time, we do it with companies all the time. If you fail to accurately describe it, it's because you had the wrong explanation in the first place. The words that you choose or you chose in order to form your hypothesis, your theory about what was going on, were inaccurate. And so one of the things that we worked on early in my career when I worked with Bill Miller at Legg Mason were how many ways we could redescribe something. So he'd say, okay, you like this company. Tell me what this company does. Describe this company to me. And we would describe it. And he goes, now describe it differently. What else, how else could you see it? Turn it upside down, to twist it and change it. How many different ways can you think about describing a company? And it's really fascinating. If you really put your mind to work, you can come up with multiple descriptions of the same thing. And if you do that, then you really have to work hard trying to figure out which one is right. So it really takes you down a level of analysis that not many people go through, because they start with what they think is the right explanation to form the description, and they just hang on to that. But we're always trying to look at things from different angles and trying to figure them out.
I love that. So speaking of Bill Miller, you had a really, really good little expose about him, about Dell Computer in the same book. So
yeah.
He saw that business a lot differently, apparently, to other investors. The evidence in that, was that he bought it at a really good price, 5 times earnings, and then he didn't sell it when it got re-rated up to a normal computer manufacturing re-rating of, say, 12 times earnings. So he saw that Gateway, a business most people would consider a Dell competitor, was trading for a steep discount to Dell. But when Bill dug a little deeper, he saw that Dell had returns on capital of like 200% versus only 40% for Gateway. So the evaluation in that case was justified. So my question for you, and you just went over a really good mental model that you used to do with Bill, but what are some other mental models that Bill imparted to you, or that you use with Bill, that helped you dig a layer deeper than other investors are willing to do?
Yeah, that's good, Kyle. And let's just take a second on that description. The first thing with Dell Computer was, and you hit on it right away, which was, it was a computer manufacturer, but because it was a direct distributor, it didn't have any retail, margins to deal with. And so by selling direct, they could sell those things at cheaper prices. But what wasn't quite clear for a lot of people at the time is that Michael Dell could actually purchase on time, keyboards, monitors, the stack, the microprocessor, whatever he could. He wouldn't have to pay for it for 90 days. But You need to bring those parts in, assemble the computer, and sell it to a customer that day, get their credit card information. They'd have the cash. And so he had the cash in the company before he actually had to pay the suppliers. And so that was a negative working capital. So there was very little capital in the business. But one that I think might be helpful for your listeners was Amazon. We did the underwriting. We were participating in the IPO of Dell Computer. Of Amazon. And we were fascinated at how badly people were describing Amazon at the time. They, Amazon, it's amazing, it's been a high multiple stock since day one, almost a no multiple stock from day one. And it turned into $1 trillion business, even with a high multiple, which would tell you right out of the blocks. Price earnings ratios have nothing to do with valuation, but we'll save that for another time. But the problem with Amazon is that they first described it as Barnes and Noble. It was just doing books, right? And so Amazon was selling books, but, Barnes and Noble was trading 10 times earnings, price to book value that looked reasonable and all these things. And they decided Amazon was just grossly overvalued. And then they started to do household products and kitchen products and say, oh, it's not Barnes and Noble, it's Walmart. And then they would look at Walmart and they would say, well, Walmart's trading much cheaper than what Amazon is. And so you should basically short Amazon and go long Walmart, which was a terrible pair trade. You got crushed on that one. And so they were misdescribing it all the way down. But Amazon was not Walmart. Amazon was not Barnes and Noble. Amazon was actually Dell Computer because basically it was growing its business off the receivables. In the book business, sometimes you didn't have to pay for the books for 6 months. And sometimes you could return them for free. And the same thing else, you could get the product in, get it out the door, get the cash that night, and you were growing your business on the accounts receivables of your customers. And once again, Amazon, before it dropped to the bottom line, was already generating triple-digit returns on invested capital. So when we were doing Amazon, we were looking at all the different ways to describe it. And sure enough, the people that misdescribed it had the wrong explanation. It wasn't a retail store. It was more of a direct distributor of consumer products that they didn't have to pay for 60, 90 days, which allowed them to expand the business off the customer's receivables. So that was a perfectly good example of how to think about descriptions and explanations and things like that with different companies. And then, so your second, so what else did we learn from Bill? Well, probably, and it did, because Bill, back when Bill was he did his PhD work at Johns Hopkins, absent his dissertation. And so he was a grad student. He taught at Bliss Philosophy Department, well versed in it. And so in addition to Wittgenstein, we would study William James and pragmatism and stuff like that, which I think is a great poster child for investing because markets change all the time and you have to be pragmatic about how you think about it. But if I were to say that there was one part of the multi-discipline, multi-model framework that really hit home for us was the work that Bill, latched on to in the Santa Fe Institute out in New Mexico. Santa Fe Institute's a multidiscipline research institute that studies complex adaptive systems. Complex adaptive systems are anything from like your nervous system to your molecular system to any biological system that you can think of. What's in common is that they have millions and millions of, interacting agents that evolve and adapt over time. And their work that was done early in the 90s with a group of scientists, one economist named Brian Arthur in particular, began to think about markets and economies from a biological perspective, not a physics perspective. Now, all investing and all accounting and everything else kind of grew up in the Newtonian framework of equilibrium. The third law of Newton, for every action, there's an equal and opposite reaction. So everything was thought to be an equilibrium. And if it got out of equilibrium, it would snap back very quickly. So all the models used to describe markets and the economy are Newtonian in base. But these guys at Santa Fe were saying, no, that's not the right model. It's more of a Darwinian model of evolving and adapting. And so then you go, okay, so if I'm going to study living systems and study adaptive systems, what are the commonalities? And they're nonlinear, the nonlinearity. Newtonian systems are linear. For every action, there's an equal and opposite reaction. That's linear. Nonlinear is that you could have a very small incremental thing happen in the market. You could have a huge consequence. Or you could have a huge consequence that has no impacts on markets. And so it began to help you think about how markets react They don't always react to news in a way that you would think they would react. The other thing that we learned at Santa Fe was how to think about network economics. And we're really in this kind of fifth stage of technological revolution that's gone back about 250 years, but we're now in what's now called the digital technological age, where the product is knowledge. The product is, your thoughts, information, and things. It's totally different than the brick and mortar world. Totally different. And in the technological revolution that we're in now, with knowledge being the product, if you will, you get into what's called increasing returns economics, which is the bigger the network, the better the network, the better the network, the bigger that it becomes. You get path dependence, lock-in, feedbacks, and things like that. And the economics of the business can actually continue to go up the bigger the company gets. And this is totally 180 degrees different than how most people think about brick and mortar, because in classic economics, it's called diminishing returns. You get to a point where you exhaust the marketplace, where if you added one more unit of production, you would get a lower return for that investment, diminishing returns. In knowledge-based economies, which is what we're in now, you get increasing returns, where actually the returns on your capital, your returns on your business actually go up more and more the bigger you get. And that's counterintuitive. And you hear it all the time. Apple is a $1 trillion business, can't get any bigger. It's in a bubble. So something becomes a $2 trillion business. Well, oh my God, it's got to be a bubble, right? All of them now are $2 and $3 trillion businesses. And this is absurd. It's a bubble. That's their explanation. No, that's not the right explanation, because they've got the wrong description. The description is these are network businesses, and network businesses, the bigger they get, the more profitable they become, the higher returns that they can get. And then when you overlay them in the global marketplace, we're not talking about 360 million people here or 380 million people here in the United States. We're talking about 8 billion people on the planet, of which Apple has products with 2 billion. So 25% of the people on the planet have an Apple product. Okay. Well, we know enough about Apple is that those 2 billion people are not going to change phones. They're going to stay with Apple for a very, very long time. They're going to stay in the iOS ecosystem. It's where they're comfortable to operate, where they feel good about it. And so it's very possible, very likely that the Googles and the Amazons and the Microsofts and Apple and the rest of them will continue to grow and be bigger businesses and also have bigger economic returns. It's amazing to me that Apple today has 140% return on equity. We're talking about 15% return on equity is the norm for the market. And here you have a company that's, earning 140% return on equity. You ought to pay attention to that. That should be something you should think about. So that the Santa Fe Institute was a huge home run for us, intellectually speaking, to begin to think about the new franchises. As Buffett says, the next fortunes will be made in the new franchises. Well, the new franchises are network economics. And when you begin to understand the moats that surround network economics, there's your franchise and there's your excess return. So that was a big deal for us.
Excellent. Love that. So John Burr Williams, who you outlined very well in Investing, the Last Liberal Art, came up with the conclusion that an asset is worth the future cash flows that it produces, discounted to present value. But he wrote this in 1938. And in modern times, interest rates are super volatile, but they've been volatile for forever. But, they're out of our control, and obviously widely different interest rates can drastically change the intrinsic value of these cash flows. Yeah. So do you still think that this formula is as useful today as when he wrote it back in 1938?
Oh, no, it is. It's definitely the right formula. I mean, without a doubt, the discounted present value to future cash flow streams determines value. And I would even gloss it one more way, is that all the value of an investment is what's going to happen in the future, not the past. So we have to look forward. But what you hit your finger on, and I think it's worth a discussion, is what do we discount those things at, right? What do we discount the cash flows? And so when you think about that, it was modern portfolio theory, which is a subject into itself, how that evolved from the 1950s and then actually gained traction after the 1973-74 stock market crash. You might recall that they began to think about discounting cash flows as a combination of the risk-free rate plus some equity risk premium. The equity risk premium being determined by the volatility of the underlying stock or the market. So you had these two inputs. And Warren Buffett, who I obviously overdosed at a young age, spent a lot of time he's the antithesis of modern portfolio theory. He just doesn't believe that price volatility equals risk, which is the cornerstone of modern portfolio theory. And the way to tampen down risk is to run broadly diversified portfolios, which is exactly the wrong way if you want to generate returns better in the market. So modern portfolio theory teaches you how to be average. And by the time you reduced it by your expenses, trading costs, whatever the case may be, it's why most modern portfolio theories can't beat the market. But Charlie Munger, along with Buffett, began to talk about what do they discount those cash flows, the John Burr Williams cash flows. It was 1992 that Warren introduced John Burr Williams to the Berkshire shareholders and said, it's not high PE, low PE. It's not high price to book, low price. It's not any of that stuff. It's the cash that comes out of it. It works for the bond market. It works for the stock market. It works for businesses. That's how everything is valued. But then the whole idea about discounting got to be puzzling because Warren said that he would discount by the risk-free rate, which would be the 10-year treasury. And when I wrote the book in the 1990s, we were looking at 10-year yields at 8%, 7%, 9%. So that was pretty high. He didn't add an equity risk premium. He would just adjust the purchase price for the riskiness of the underlying business, the predictability of the underlying business. But then Charlie came up with something interesting. He says, we discount by our opportunity cost. And I thought about that. I said, okay, let's go through that. And he says, if you were to lend money to the stock market, you're going to lend your capital to the stock market. Your expectation is to get at least a 10% rate of return. That's been the average return for stocks for pretty much a century. So if I'm going to give money to the stock market, I expect to get at least 10% back or more, certainly not less. I'm lending you money. The average return for stocks are 10%. I expect that's my opportunity cost. So when we began to think about that, we began to think, well, probably the right idea is to discount your cost of capital by your opportunity cost. You're lending money with an expectation of 10%. So let's discount it 10%. Let's not worry about the risk-free rate. Let's not worry about the equity risk premium. Just the historical rate of return of stocks being 10%, that would be my opportunity cost to lend you money. I'll discount the cash flows at 10. If we do better than that, great, but we better not do worse than that. So that's kind of how we get to it.
Oh, that's excellent. So in investing, the last liberal art, you said, quote, to build good mental models, we need a general awareness of the fundamentals of various disciplines, plus the ability to think metaphorically. So one problem I've been trying to solve is making thinking in multiple mental models into a habit. You probably already think this way, but for myself and other investors in the audience, what are the best ways to apply these various mental models into our thinking on a daily basis?
Well, you're right. It does. When I wrote Investing the Last Liberal Art around 2000, and, it takes a while to incorporate it. But the best way that you can do it is I'm looking at my library. I can't see it here on the camera, but across the room there, I have a library shelf full of books about physics. I have a library shelf about biology. I've got sociology over there, psychology, philosophy, mathematics, art. I didn't talk about art in the book, but we'll maybe do that one day, history and all that. So what I will do, every once in a while as I'm heading out the door, I'll just try to grab a book from a different, shelf and just try to keep myself fresh in the discipline, just to kind of keep myself aware. I'm already, not saying that physics is where I'm going in life, because I think it's more of a biological system than a physics system, but you just begin to allocate your time in your reading to things other than just finance and accounting. You've got to keep up with the news. It's information. You've got to get the facts of the moment, but your allocation of time should be spent studying other things as well. Sociology is how to think about markets, and, the whole idea about diversity breakdown in markets. You can see how that works when, attitudes become one way or the other. The wisdom of the crowds type approach that we think about that as in markets. But you just have to develop a habit. There was a professor, Dr. Bevan at University of Pennsylvania, who was talking about Benjamin Franklin, who obviously started the University of Pennsylvania and considered to be one of the great liberal arts thinkers. And he called Benjamin Franklin, he had a marvelous habits of mind. And habits of mind are basically to be widely read not singularly read just on one topic. So I think you just have to discipline yourself to always grab a book outside of investing, outside of finance, outside of economics, and just noodle through it and see if there's anything that helps the light bulb go off. And I think we did something in the investment last level art, which was, when you read something, you don't have to read it slowly. You can skim it fast to see if there are any important parts that would be worthwhile for you to spend more time with. So it's called intelligent skimming. So, when I go through a book, I'll try to go through it pretty quickly, and go through the indexes and footnotes to see if I see anything new and different. And I'll read the first chapter, sometimes the last chapter, to see if anything sparks, because your time is valuable, and you don't want to let a book take up more time than it deserves. If it deserves your time, great. If it doesn't deserve your time, then you need to move on, but you won't know that until you get through it pretty quickly. So the first pass through is not like reading, a holy scripture. You're just trying to get through here. What are the high points here that I want to think about? So you can motor through more books if you do intelligent skimming. Then if it's good, then you go back and you slow down and you underwrite, highlight, and you make notes. But that's kind of how I attack reading.
Excellent.
Hey everyone, I just wanted to take a quick moment here to tell you about this premium superfood shake I have recently fell in love with called Kachava. Kachava is made from plant-based ingredients to power everything you do and help you feel amazing. In every serving, you get a balanced blend of superfoods, nutrients, plant-based protein, adaptogens, antioxidants, and so much more. As if that wasn't enough, Kachava also tastes amazing, and it's helped them earn tens of thousands of 5-star reviews. It's creamy, smooth, and it comes in these 5 delicious flavors. To make it, all you have to do is add water and a little bit of ice with 2 heaping scoops of your favorite flavor. Then shake it or blend it and have it ready in seconds. Personally, I like to drink Kachava as a quick and easy breakfast, or even as an afternoon snack when I'm craving something healthy to help me fuel my workday. I'd encourage you to give it a shot too, because they have a love it guarantee, meaning that if you don't love it for any reason, you can just get your money back. We Study Billionaires is thrilled to partner with Kachava as they're offering our listeners 10% off for a limited time. Just go to kachava.com/WSB. That's spelled KACHAVA and get 10% off your first order. That's kachava.com/WSB.
So with markets tanking in the month of September, going over some of Buffett's major tenets during this volatility is very prescient. I think Buffett would agree that volatility is a feature of the market and not a bug. What actions do you think Buffett and other Buffett disciples would be doing during these turbulent times to best take advantage of the volatility we're seeing in today's markets?
Absolutely. Yeah. I mean, the one thing that I would say with Warren is that, volatility is his friend, right? Now he has a longer horizon than we do, and he's not measured quarter to quarter, month to month, and maybe not even year to year like mutual fund managers are, professional managers that are, I think, unrealistically held to shorter term performance benchmarks. But for him, volatility is his friend. I think he, had a quote that I always liked. He said, "Widespread fear is your friend. If the market is gripped with fear and panic, that's your friend, because you're going to get some great prices." He said, "Personal fear is your enemy, because once it becomes a personal fear, then you begin to do stupid things," right? And we see it now with our advisors, that with the headlines, and the headlines are very, very tragic around the world, with what's going on in Ukraine, what's going on in the Middle East and in Israel. And then we've got headlines with politics coming up and shutting down the government. We've got headlines with inflation. We've got all these headlines, right? And to the degree that you let them start to rule you in that fear, and it becomes a personal fear, then you're cooked. You're just not going to be able to take advantage of it. So widespread fear that then is reflected in, stock price volatility actually is the friend of the long-term investor, because it allows them to pick up more shares at cheaper prices. That allows you then to compound a larger number for your portfolio that will increase your rate of return over time. So we nobody likes volatility, but price volatility is not risk. Short-term quotational loss is not capital loss. There's a big difference. Short-term quotational loss is just the market doing its funny stuff. Permanent capital loss is serious, and that's what we try to avoid by owning good companies, good balance sheets, low debt, predictable. We're not concerned about permanent capital loss in our portfolios. And we don't view short-term quotational loss as a measure of risk. It's an opportunity if we can put it to work.
Excellent. So another awesome topic in investing, the last liberal art you discussed was the returns that Warren Buffett and his friend Bill Ruane had during the sideways markets of 1975 to 1982. So in these sideways markets, the price of the Dow Jones Industrial Average started and ended at 784. Yet Buffett and Ruane made cumulative returns of 676% and 415% respectively. And their trick? Extending holding periods. Can you go over the data that you found and the primary lessons that you learned from this research?
Yeah, what a great question. I'm glad you brought that up because I actually, I redid that research report at the early part of the year because I think some people are coming to a viewpoint that maybe we're in another sideways market. If you think about it, for 2 years, we've kind of gone sideways. So I was working with Bill back then. It was after the financial crisis. And people were saying, we're probably in for a sideways market. Now, sideways markets happen all the time, but we have a tendency to think about markets in bulls and bears and don't realize sometimes they just kind of go sideways for a while. And they're really quite common. Now, the uncommon ones, as you pointed out, Kyle, thoughtfully, is, the 75 to 82. And that was a period, not something not identical to now, but it was a period of high inflation, high interest rates, geopolitical risks. And as you rightly pointed out, the Dow didn't move for much of that period. So the total return for the Dow was the dividend returns. Basically, the average return for the Dow was about 4% annual, which was the current dividend yield of the Dow. So on a price basis, nothing, and you just got the dividend. S&P did a little better. It was almost an 8% average annual return, which was pretty good. But once again, half of that was dividend yield. So we went back and looked, and I, as I said, overdosing on Buffett and stuff like that. I knew Buffett killed it. And so we basically did the research to look at the S&P 500 back then and break it apart and discovered that, yes, over, 1 year period, stocks didn't do well, but if you extended the time horizon, you basically began to see that there were some stocks that actually were doing pretty well. And there were some stocks that were doing not so well, but in fact that there were stocks going up multiples made you think what was going on. So then we parsed the data even further down by sectors and found out that oil was a big performer. And that was, not difficult to discern because we had the oil embargo in 73 when they had the Middle East war and everybody turned off the oil spigot and didn't sell oil to the U.S. So oil prices went up, gasoline went up, inflation went up, interest rates went up. That was a very hard period. Industrials did pretty well, but later down the road was consumer cyclicals, and within the consumer cyclicals there was Buffett and there was Sequoia. They owned newspapers, magazines, television stations. Right? They weren't capital-intensive businesses, so they weren't required to reinvest capital at high rates, high interest rates, because once you put up a TV tower, you put in a printing press or whatever the case may be. There's not much capital expenditure after that. So it was just a cash flow business. And they were able to price because before the internet, the only way that you got information or you could get advertising out was either through TV, newspapers, magazines. And so if you looked at their portfolios, that's exactly what they own. They also own advertising business. It's the same thing. So consumer cyclicals. And then the second smallest sector in the market was technology. Technology wasn't a big part of the market in the 1970s, but almost every single stock in the technology sector doubled over 5 years. So it led you to think about the difference between trends of the system and the trends in the system. And that's something important to think about markets, which is the market's going sideways. That's the trends of the system. The system's going sideways. But there are trends in the system where there's some things going up a whole heck of a lot and some things going down a whole heck of a lot. And they basically equalize out and you get this flat line in the market. But recognizing there's a difference between the trends of the system, and the trends in the system, no matter what the market is doing, there's something going on in the market. You just got to go tease it out. And that became very, very important for us to think about. And so what we then began to think about is that in sideways markets, there are two pots of money or two parts of the investment pie that are going to be very important, which is high yield. Anything that it's going to have high income, if the price is going sideways, high income is going to be pretty good. High dividend paying stocks. I think the yield on the S&P, you can correct me, Carl, but I think the yield is maybe 1.8%, 1.6%. So if you're in a sideways market for the S&P, you're not going to get 4%. You're going to get 1.6, which is going to be less than real estate. So you have to think about, are there dividend paying stocks that can get me 3, 4, 5% that might be interesting? Now, they've gotten bruised up a little bit with this last bump in interest rates, but that's probably coming to an end. So high yielding stocks, high dividend paying stocks make a lot of sense. And then growth companies that can actually grow through this, that aren't capital intensive, that have pricing power, that can move, that are in high demand around the world. Growth in a sideways market is very, very valuable. So it's almost a barbell approach where part of the portfolio might be classic value, high dividend paying stocks. The other part of the portfolio may be your secularly advantaged growth companies, like I was talking about, network economics and things on the internet, software businesses. This AI thing is the real deal. How does that impact sales and earnings? Things that can grow secularly advantaged with high returns on invested capital are going to do well. And at the opposite end of the barbell, the high dividend paying stocks. And so not knowing how long this would be a sideways market, it could change, who the heck knows. But if you said to me, we're going to be pretty much at the same place next year as we were this year, then that's the kind of portfolio that I would want to run.
Excellent. So one of the biggest takeaways that I had from the Warren Buffett portfolio was your excellent research on concentrated portfolios. The research from CompuStat that you did in that book looked at 1,200 companies between 1979 and 1986. The conclusion was that holding fewer stocks increased the probability of generating market-beating returns. Could you discuss some of the details you took from this study?
Yeah, that was Warren once again. So I had written the Warren Buffett Way in 93, 94, and it done quite well as a testament to Warren. It was one of the first books to come out that actually went through the methodology. And I remember in writing it, it was 30 years ago. Can you believe that? 30 years coming up, 2004, it came out, 94. Basically, I was so challenged, I guess, and anxious about making sure I had the right methodology, what we call the investment tenets that Warren Buffett used to select stocks. I didn't spend any time on portfolio management. I think the entire portfolio management explanation of the book was, he owns a few stocks and he holds them forever. That was it. I spent all my time analyzing, Washington Post, Gap Cities, American Express, Coca-Cola, Geico, all that stuff, because I was going to get that part right. So after the book came out, I was watching, one of the financial news, programs, and there was a portfolio manager on there, and then said, I just like to buy, businesses that I understand that have got a good long-term outlook. I went, yeah, that's Buffett. And he goes, I like cash earnings and, good returns on equity. I went, yeah, that's Warren Buffett. And, we like management who's rational and how they think about allocating capital and that are honest and straightforward. I went, guys on board. This is what I want to hear. And he goes, yeah, and we always buying for less than they're worth. And I went, oh, touchdown, the Warren Buffett way. And then I looked up the portfolio and they have 100 stocks and 100% turnover ratio. Wait a minute. You got the first part right, which is, how to think about stock selection, but you totally whiffed on the portfolio management. So that led me to understand and appreciate that I'd left out half, which is stock selection. The other has portfolio management, and I left it out. So I had an opportunity to call Warren, and this was years ago when he wasn't 1/10 the busy as he is today, right? And I said, I'm thinking about doing a portfolio management book because I left that out. And he said, well, Rob, we're focus investors. We just focus on a few stocks. And so focus investing, was the subtitle of the book. It was, the Warren Buffett portfolio, mastering the focus investment strategies, something like that. And we did. So basically all we did, and it was very simplistic, very elementary when I go back and look at it. We just took these 12, we needed to get basically 3,000 portfolios. Once you get to 3,000 portfolios, it's statistically significant, the conclusion you draw from. And there wasn't 3,000 focused portfolios out there at the time. So we basically took 3,000 portfolios and then we did them with, I think, 15 stocks, 50 stocks, 100 stocks, and 250 stocks. And then we just ran through the computer, both for 10 years and 15 years. And to the T, what you found is, to the degree that you own more stocks, your returns were very much at the market rate of return. And to the degree that you own less stocks, you had a higher percentage number of your portfolios beating the market, but you also had a higher percentage number of the portfolios underperforming the market. And so there was the dilemma, right? And as Warren has said famously, so if you're a know-nothing investor, you can't do stock analysis. You don't have the temperament to think about markets in a rational way. Then you should own a bunch of stocks like the S&P 500, and you will get a good 10% rate of return over time. Nothing wrong with that. That actually beats about 90% of the active managers out there. He said, but if you're a know-something investor that can do analysis, that has the temperament, you don't need that many stocks. And, 10, 15, 20, 25 stocks is more than enough. So we looked at, Buffett's performance in the partnership, and it was phenomenal. We looked at Charlie Munger's performance in the partnership. It was phenomenal. We looked at Sequoia Fund. We looked at Lou Simpson, who managed money at Geico. We even looked at John Maynard Keynes, who ran the chess fund for Cambridge for so many years, all concentrated low turnover portfolios, with the exception of Buffett, who never had a bad year in the 13 years that he managed the Buffett partnership. Every one of those guys only outperformed the market about half the time on an annual basis. But their returns were through the roof, right? And so what happens in concentrated low turnover portfolios, if you've got the right company, you're going to compound money over time, but the market is gravitating around you all the time. Sometimes it likes oil, then it likes pharmaceuticals. Now it likes small cap. Now it likes international. Now it likes technology. So it's going through all its ebbs and flows. And sometimes the light shines on you and sometimes it doesn't. And when it doesn't, you underperform. And when it does, you can make a lot of money. And so each of them had great long-term track records, but the frequency in which they beat the market was about batting average 50%. And so then we were led back to a mathematical constant, which is, the returns in markets are not how many times you beat the market, less how many times you don't beat the market. It's how much money you make when you beat the market, less how much money you get back when you don't. And what we saw with these guys and others is that when they beat the market, they just killed. They were off multiples. And when they gave back, they didn't give back so much. Why? Because they were doing valuation work. They weren't overpaying for growth stocks, so they weren't overpaying for stocks. And so when the market moved against them, their downside was not anywhere near as horrible. And so we then began to understand, okay, this makes a whole lot of sense. Now let's fast forward. Today, around 2003, 2004, two professors from Yale University, Martin Kremers and Pettigiusto, brought out a paper called High Active Share. High active share is now the academic word for focus investing. You can measure your high active share to the degree that you're different than your underlying index. If you own everything in the index, your active share is zero. You're no different than the market. If you own 15 companies, 16 companies of different weights, you can have an active share because of your differences in the market of 85, 90, 95% active share. They then concluded, they did the research on all actively traded portfolios and found out those with high active shares, the most concentrated, were the ones that outperformed the market. You had low active share, which is kind of closet indexing. You couldn't beat the market. And then they followed up the study with turnover ratios and found out within the high active share quadrant, those that had low turnover strategies actually had the single best performance, just exactly the same portfolio that Warren Buffett does. So concentrated low turnover portfolios is absolutely 100% academically settled, no more debate, the optimal way in which to manage portfolios to generate a return better than the market. But there's a problem. Because people want to have performance every month, every quarter, every year. They don't like it when they underperform. And in high active share, focused low turnover portfolios will underperform from time to time. So you've got to make sure you have the right fit between the client, the investor, and a high active share portfolio. Because I have learned over my 30 years, I've never met anybody who disagreed with the methodology that Warren Buffett does. I said, look, this is what Warren's doing. Do you want to do it? Everyone says yes. And about 3 months later, 2 out of 3 can't do it anymore. They just fall out. Being out of sync with the market or not owning what's going up in the market in the short run. They know it, but they can't walk the path. It's a difference between knowing the path and walking the path. They know the path, but walking the path as a focused low turnover portfolio requires a temperament. And Warren would say it's a business person's temperament. You're not buying a stock, you're buying a business. And if you frame it as a business, it's less frightening when you underperform the market because you actually understand your business and you understand the revenues and the earnings of the products. And so when you're underperforming, you're like, so what? This is a great business. It'll outperform later. But you have to get the right You got to get the right mix of people.
Excellent. So in Money Mind, you wrote a great passage, quote, all these separate components, your view of the market, your methods, and your temperament as an investor reflect the totality of your philosophy of investing. When all three are working in harmony, we might even say we're looking at a person who displays a money mind. For readers who have not read this book, what parts of each of these components should they try and develop skills to one day acquire a money mind?
Great question again. I think the way in which we kind of approach Money Mind, which is not a method book. The Warren Buffett Way and the Warren Buffett Portfolio are methods. These are the methods, the steps that you take in order to select stocks optimally, in order to manage portfolios optimally. And I spent the lion's share of my career focusing on methods. If a client was struggling, I'd just sharpen my pencil and try to figure out, well, I just keep working on the valuation to try to convince them that they have a good investment. So I was always focused on methods, but learned that methods alone is not going to get it done. And that's where the money line came in that Warren introduced in 2017, which is a term that he used about how to rationally allocate capital, a reflection of their temperament. And when you rationally allocate capital, you think about putting capital to work at lower prices, not higher prices. Those lower markets are your friends, right? And so how you just think about allocating capital and how you think about changes in stock prices is a function of temperament. The money mind is a temperament model. And it works in such a way, Kyle, that you almost have to turn the stock market off. You almost have to disengage with the stock market and treat it as a sideshow, versus the centrality of how you think the world is to always look at the screen with red and green on it and what did it do today. It's interesting, I'll throw this out at you, Kyle, and you can push back on me. Warren Buffett's clearly probably the most famous celebrity in the stock market today. Warren Buffett Way in 18 foreign languages. Everybody knows Warren Buffett. And if you would say to him, you're a celebrity of the stock market, he would go, it's kind of a shame because I really don't agree with the way most people invest in the stock market. He said, it's kind of like just because, stock prices or companies have a public stock price, right? It makes people act in perverse ways, which is, let's just say Apple was a private company or Google or Amazon was a private company. And once every 3 months, you could go to the board and you could buy or sell stocks, like shares in those companies. But the rest of the time, there's no stock price. So what are you going to do? Well, you probably look at the quarterly reports, you think about trade magazine, you think about how the business is doing. You go through what a business owner goes through every single day that doesn't have a stock price. Now, the question then becomes, if that's the way a business person operates owning a private company, why is that not considered the proper way to think about investing in a common stock when it has a daily price? Or put it differently, just because a common stock has a daily price, why do you act so bizarre, perverse, right? You're trading too often. You're trying to make bets on the economy that you can't predict. Another thing about the Santa Fe Institute, the complex adaptive system, there is no science that can predict the complex adaptive system. It's not been invented yet. So all these market strategists, all these economists that are constantly telling you what's going to happen in the economy and the market, they have no idea because there's no science that can tell them what is going to happen. At best, it's a hunch, right? At best, they're weighting probabilities. But if anybody had the model to predict economies in the markets, they have all the gold, but they don't. So the question then goes back to, just because there's daily stock prices, why do we behave so poorly, so badly, so in such ways that are adverse to our long-term best interest? And there's, to me, a puzzle. If you can answer that and solve that for mankind, people would do a lot better in investing.
Yeah, I completely agree. One of the things that I've worked on myself for my own investing was just creating a environment where I'm trying to make fewer mistakes. Like, I know a lot of people check their portfolios, 50 times a day. I used to do that. And you just put all this stress on yourself. Yep. And so I was just like, you know what? I'm not going to do that. Deleted all my apps. And I just basically refused to kind of bite into that, the dogma that most people follow. And that helped me a lot.
I think that's brilliant. I think that's what people should do, until at which point you can look at it with detachment. You can look at it just as, almost like a cartoon. It's kind of like, oh, I see what it's doing today. It's acting silly. It's kind of like, the road runner's going off the cliff. It's kind of okay. You can look at it, but you're not absorbed by it. It's not ruling you. You're just observing, right? To the point when markets are ruling you and forcing you to do things that you otherwise would not do if there were changes in prices. That's where you run into the problem. But, people say to me, what's the best advice? I just say, turn it off. Turn off CNBC, turn off Bloomberg, turn off everything, and turn it on the weekend. In the old days, before there was internet, we just get the Barron's on Saturday. We'd look at prices once a week, kind of check the portfolio and check the mutual bonds, But now you're right. People do it. When I leave this afternoon, I'll stop by. I'll see people on their phones checking their portfolios. I'm going, you're no richer today or tomorrow than you're going to be next week. So, relax. It's going to be fine.
Yeah.
But you got the right answer.
So I really enjoyed how you linked Ralph Waldo Emerson's teaching on self-reliance to how Warren Buffett thinks.
Yeah.
You outlined three major themes from Emerson's essays that Warren has lived by to this day. Quote, first is solitude and community.
Yeah.
Emerson warns us that community is a distraction to self-growth. He believes more time should be spent in quiet reflection.
Yeah.
Second is the sense of nonconformity. Emerson said, quote, whoso would be a man must be a nonconformist. He argues that an individual must do what is right, no matter what others think. Lastly, the theme of spirituality is especially important. Emerson tells us truth is within oneself and warns that relying on institutional thought hinders an individual's ability to mentally grow. Now, can you outline how Warren has utilized these three themes in his investing career and give some examples of how investors can use it to improve their thinking?
Yeah, well, we said in the book that he learned the philosophy of Emerson from his dad, Howard Holman Buffett, who was a great man, most important man in Warren's life. And he was a politician, but he was very much he was a libertarian, kind of get at the root of it. He was friends with Murray Rothbard, who's a big libertarian. And libertarian is always about the celebration of the self over the state, where the state is not thought to be able to make the most optimal decisions. The self can, the individual can. And so Emerson was trying to point out, to the degree that you sit in quiet reflection and solitude and think and read yourself, as opposed to being in the mosh pit that is the stock market, listening to, hundreds of people have opinions and stuff like that, it's more likely that you're going to be more successful to the degree that your reflection is in solitude and reading and things like that. So think about Buffett. All Buffett does is read. That's all he does. Occasionally gets on the phone. Some say he has CNBC, but I've heard from credible sources he keeps the volume off. He only leaves it on in the corner, perchance something interesting about a company he owns or might want to own flashes across the screen. He doesn't talk to other people about the market. One, they don't know what they're talking about. And two, it's like, I'm making the decisions. They're not making the decisions. I'm making the decisions. I'm not going to turn my money over to them. So what do I care what they have to say? So it's this whole idea about the self, and to the degree that you invest in yourself by reading, reflection, and educating yourself, you strengthen your ability, you strengthen your resolve to act appropriately, optimally at those times, independent of what's going on in the community, what's going on in the market. And that's what you have to do. And to be a nonconformist, I'll preface it with this. One of my favorite Buffett days, polling does not replace thinking. Now, I like contrarianism, but there's some things that go down that are supposed to go down, and there's some things that are going up that should continue to go up. So contrarianism in of itself is not the right way to think about it, but you do want to take a different tack. If you're always walking lockstep with the market, it's going to be hard to beat it. So you want to find pockets of inefficiencies in the market where the market isn't right. So you're not in conform with the market. You're acting in juxtaposition to the market's thoughts and wishes, and there goes back to self-reliance, or the mirror image of self-reliance is self-confidence. That self-reliance, self-confidence is what allows you to make bets independent of what's going on in the market without needing the market to affirm you being right or wrong at any point in time. You're doing it yourself. It's in you. And so that's a very big deal. And so there was a study Michael Mauboussin did one time. I don't know if you know Michael, but great writer and author and professor at NYU. And he looked at some of the most famous investors in the world, and they typically lived outside the New York City. Omaha, Memphis, there are places around the world where they were not near any of the chatter. They were not in the chatterboxes. And I know a lot of guys outside of New York, and they just seem to be so happy and so relaxed and just so at peace. And that's Omaha for Warren. It is, kind of a quiet sanctuary away from Wall Street that protects him from being, influenced by the community, by the bigger whole. And that education gives you that self-confidence, self-reliance to make bets that are not in conformity with the market, but are probably the source of your excess return because the market's mispriced.
Yeah.
Did I answer that well enough?
No, that was great. Thank you. So you outline a few key attributes of the money mind that Warren learned from his great friend and partner, Charlie Munger. The first was that a money mind seeks to build worldly wisdom. Second, the money mind actively studies the failures of others. Third, the money mind is a rational mind. And fourth, the money mind is pragmatic in the sense that it appreciates knowledge, but always knows that there's much to learn. Now, I want to focus on the second attribute here. What are some of the best people, businesses, events, or research that investors should study in order to avoid making the most common failures of the past?
Good question. I think given the choice of, let's put it this way, there's just but a handful, less than on one hand, of analysts. I don't follow market strategists or people predicting markets, but people that I actually think understand businesses that are on Wall Street that I favor, that I think are quite good. But I'm very discriminating. They have to earn my trust, and they got to achieve certain things for me to understand that I think they understand how to value businesses. So set aside those select few. I found the stuff that I enjoy reading would be like trade magazines. Things about the industry. So if you're in the computer business or you're in software, something, the trade magazines and things like that, what's going on in the businesses, not what's going on in the markets, not what's going on in the economies, what's going on in the business landscape. If I we own a business called Diageo, which is the world's largest spirits maker. I read a lot about it. We own fashion good businesses. We own Louis Vuitton, Richemont. I love reading about fashion and fashion goods. That's one of the the hierarchy of needs that people, as they get discretionary income, the first thing they want is better tasting food. Second is they want better tasting liquor. Third is they want household products and beauty care products. And then fourth is fashion. They want that aggressive. We know that they're going to get there. And so I just like to understand what's going on in the fashion world, what's going on in the spirits world. We spend a lot of time in tech. We spend a lot of time in software. We're spending a huge amount of time in AI, which we don't believe is a bubble. It'll be interesting to see how this, morphs over time, but it seems to be the real deal. To the degree, though, that I'm reading that, I'm not reading the stock market. I'm not reading an analyst who's saying, I think the stock price is this. Who the hell knows, right? I just want to be I want to be the best business person I can be. If I can be the best business person in my portfolio, then I probably will be the best stock picker as a result of it. Or as Warren says, we're business pickers, not stock pickers. If you start as a stock picker without understanding the business, you're in trouble. If you start with a business person's perspective first in the company that you own, then thinking about the stock price later becomes much easier. So trade magazines, anything other than the stock market is what you ought to be spending your time on. And books. I mean, there's a lot, great books all the time, right? I'm not trying to promote this book, but this book, James Besson, The New Goliath, How Corporations Use Software to Dominate Industries. Okay. I own software companies. I'm going to read this. This is a book that, would be very interesting to me. And so, it's not Wall Street research now. Do I read Barron's? Do I read the New York Times? Do I read Wall Street Journal? Yes, I do. But it usually is just for facts and information. And that's not where wisdom is. Books and other things is where wisdom comes from. You have to get the facts of the moment. You have to understand what's going on in the world. But that's the starting point, not the ending point. To get wisdom and to achieve wisdom, which gives you that ability to act independently of the market with self-reliance and self-confidence, you have to gather wisdom from other sources than just the market. A little bit of a long-winded answer.
So one of my favorite mental models that I borrowed from you was how you view private equity in a positive light in terms of investing time horizons. Can you outline the lessons you've learned from private equity that the audience can use to help them lengthen their time horizons using long horizon arbitrage?
Yeah. Well, when you ended it, it was actually two different things. But I thought where you were starting was just thinking about private equity into itself. I'm just so jealous of them. Right? They've got it so easy. Why am I jealous of them? Well, what do? They own businesses, right? And, they may be trying to fix the business or turn around the business or reorganize it with the idea that they're going to sell it somewhere down the road. And that's fine. There's a lot of different ways to make money in the markets. But what I'm so envious of is that they own businesses that don't have stock prices. So they don't have people dealing with myopic loss aversion and, prospect theory and all this stuff. And I look at them and I go, man, this is just not fair. I mean, you guys have got it so easy, right? All you do is just tell your people what the sales were, what the earnings were. I said the NAV barely moves from quarter to quarter to quarter to quarter. If you look at a private equity portfolio, the NAV very rarely changes, upward slope over time. And then when you sell it, it goes parabolic through the roof, right? It's one of these amazing things, right? And I said, you guys have got it so easy, and I'm so jealous. And they all laugh and stuff like that. But that's the truth. But when you said long horizon arbitrage, there's a lot of good academic work is that the part of the market that's most mispriced is long horizon arbitrage. It's the most difficult to figure out as well. Short horizon arbitrage is for traders, and that's a totally different game that I'm not into. Long horizon arbitrage, though, is where the mispricing is. And Michael Movison said to me, there are not that many companies that actually can grow at high rates of return over a sustainable long period of time. The market, figures them out, or competition figures them out, and creative destruction, shoot better, all this stuff. It doesn't last as long as it does. But if you find one that does, that can generate high returns on invested capital, that can do it over a long period of time, that can reinvest back in itself to compound over time, most likely the market's got it mispriced. So the mispricing for investors is out what happens 3, 4, and 5 years from now, not what happens 3 or 4 or 5 weeks from now. Yeah, that's hard to arbitrage. That's hard to figure that out, almost impossible to figure that out. But if you've got a company, would you think that'll be here in 5 years? I know what they do as a business. I understand their economics. I understand what management's goals and objectives are. And you look at the price and the economics for above average for the market, and they're being priced at the market, you've got an arbitrage. But once again, it's that long horizon, long-term investing, which is much harder than, trying to figure out day to day, even though nobody can figure out day to day. It's amazing how many people spend time trying to do it.
Robert, thank you so much for joining me today. Before we say goodbye, where can the audience connect with you and learn more about you and your book?
Well, Amazon's great. And I think there's a Robert Hagstrom Amazon. You just do Robert Hagstrom Amazon. They've got all the books. I work for a firm called EquityCompass, great little firm. We're out of Baltimore, Maryland. I do some writings there and commentaries and stuff like that. So I'm never too far afield. I just try to stay out of trouble and keep my nose down to the grindstone.
You're either doing this on a daily basis because it's changing so quickly and actually understand what's going on, or you're not. People always ask, how do you learn this, or where do you start? My go-to always is make a blog about a topic you're interested in, figure out how to get traffic to it, figure out how to sell something to that traffic, and you're in the top 1% of marketers if you can do that.